Hello everyone, thank you for attending today's webinar, the basics of M&A and the related points, the tax related points that revolve around M&A. So with that, without further ado, let's start. So again, I will start with the basic. What do you mean by a merger, right? So merger is a marriage where there's a company A, there's a company B, and maybe they form a company C. There can be three outcomes in situation like these. There is always a company C that can be formed. However, company A can also merge with company B, and company A can be the surviving entity without creating company C, or vice versa, where company B is merging with company A and company B is the surviving entity without having A anymore in the existence. So those are the three outcomes that typically happens around merger. Whereas the acquisition typically is a transaction where financially strong entity takes over a financially weaker entity because of many reasons. Now let's talk about why does M&A exist in this world. So as we know, people, companies, most of the companies want to grow, and when they want to grow, there are two ways they can grow. One is they can grow organically by acquiring and signing new clients, developing different practice area, developing different products, or getting into some more technical synergy. But those are the things that they can do organically. However, that is not typically sufficient, especially when the company has been in existence for many, many years. And now their product or services have kind of come to a saturation level, but they still want to grow. The leadership wants to grow. So they go into the market and they look for different targets. And there are the reasons why they do it. So first of all is to increase the revenue. That's typically when they want to do the M&A. Second is sometimes they want to enter new markets. As many of you might have heard in the news, Facebook, which is a great company here in US, recently invested 10%. They bought 10% stake in Reliance Jio, which is a well-established player in India. And they are a great player here with Facebook. They want to test the waters in India to enter the new markets. So they don't want to bootstrap from the very beginning. They went ahead and married an established player, Reliance. And one thing we have to keep in mind is whenever these M&A transactions are happening, most of the time it has to be a win-win situation. And other thing is to reduce the cost. That's the reason it happens. One typical example that comes to my mind when it comes to reducing the cost is auto industry. So auto industry is again a very capital intensive industry, as we know, and most of those players, take the example of GMs and Fords of US companies, are having these assets in place which are kind of a redundant and repetition and can be eliminated if both of those players can kind of merge and just reduce the cost, and it will save a lot of dollars in the long run. And the last one is to increase the competitive advantage. And again, the case that comes to my mind in this case is maybe take the example of Intuit. Intuit is a great company. They are tax software, accounting software provider, great service. But again, they have been growing. But recently they were really kind of getting the pressure from very unknown company called Credit Karma. So Credit Karma was a startup that happened in SFO, California. And those guys started with providing free credit reports to everybody. And sooner than later, they hit the 100 million people mark. And not only that, since 2017, what they started doing is they started providing free tax services to all these individual people. And that was a big hit on Intuit because they are well known for the TurboTax software, do-it-yourself software, and that's a big revenue stream from them. But because of this Credit Karma providing services free of cost, it was really becoming difficult for them to stay relevant. So what they did is last February, they went ahead and acquired Credit Karma, for value of $7 billion. So again, this is the case where they really wanted to kill the competition and stay relevant. So now moving on. So let's say what typically happens around M&A. What is the process once somebody has kind of, the leadership has taken this decision, they want to go ahead and move with the targets. What typically happens around this? So one is definitely the seller, who is the main player here, needs to have approval from board of directors and majority of their shareholders before they can pursue. And all the transaction revolving around M&A is governed by the state laws where actually the company is incorporated. And once they have kind of gone through these things, then there's few forms that needs to be filed, additional tax forms that can be filed with the tax returns, or election that needs to be made separately. But those are the things that we need to keep into consideration. And once then that thing is taken care of, the two things that happens in M&A is either we are trying to buy the asset of the entity, or we are trying to buy the stock of the entity. So in this case, if it's an asset purchase, right? So what happens? It's either asset purchase or stock purchase. In asset purchase, the company, the buying company is only considering to buy the assets of the company. Maybe they just want to pick 2, 3 assets out of the all assets that the company has, and they don't want to get into the liabilities of the company. And if that thing happens, the IRS has given us a residual method that we need to follow. Whenever a company buys the asset of another company, they need to classify that into 7 different categories, and starting with the very liquid: cash, marketable securities, accounts receivable, inventory, fixed assets, intangibles, and then the remaining last intangible is the goodwill. So those are the 7 categories we need to classify whenever it is an asset purchase. And a form that needs to be filed in the case of asset purchase is form 8594. That's the form that needs to be filed both by buyer and seller, and they need to allocate how much value they are giving to each asset so that both buyer and seller are on the same page. It's not like the seller is putting more value to goodwill where it gets a preferential capital gain treatment, and the buyer is putting more value on fixed asset where it gets a step up basis, for which we'll get into little more detail later. And again, when we are having this, the basic thing that happens during the M&A, again, the buyer always want to have an asset purchase, whereas the seller always would prefer as a stock sale, because stock sale has a preferential treatment of capital gain, whereas the buyer who gets as an asset purchase gets a step up basis in the asset. What are the disadvantages? See, we have heard all this, stock purchase and asset purchase, but if we really touch upon what are the disadvantages of a stock purchase, so we know when we do a stock purchase, we do not get the step up basis. Basically, we are not able to accelerate the depreciation and amortization at a faster rate, and we may come across unintended liabilities. Since I bought the stock of the company, everything comes along with it. The good babies, bad babies, everybody comes along with it unintentionally. So that's the disadvantage we have to be very, very cognizant about. And the other thing is, what is the disadvantage of asset purchase? So asset purchase, again, you know, we might have purchased 2 assets that we thought are the really valuable asset, but we might have missed on few other assets which were relevant, and we missed when we purchased the asset. So that's one disadvantage. Other is, a lot of times when we are trying to do this asset transfer, there are a lot of taxes involved on the property taxes, personal property, because of the title transferred, and there are many assets sometimes, and it becomes a very tedious process. So that's another thing we have to really keep in mind. And last but not the least, the disadvantage is the seller might have sold you 2 assets, but still kept one big asset or one major asset with them, and still keep on continue as a kind of a concern as a competitor for you, even though you thought that you bought the technology and can be just moving along with that. So now let's move on. What are the major tax points to be considered before an M&A transaction happens? So not all is bad when we are trying to do a stock purchase. One thing is, a lot of times the companies that we are trying to purchase might have NOL, which is net operating losses. So when we merge with an entity which has a net operating losses, and we might have gains that we are having every year, we might be able to write off those operating losses against our income. Of course, there are some rules, some limitation under IRS tax code section 382, which limits us how much NOL we can claim every year. Other thing we have to always keep in mind is capital gain versus ordinary gain. If it's a asset sale, again, anything that we are pertaining to accounts receivable, depreciable asset, which is again subject to depreciation, recapture is going to be under ordinary gain. So anything which is stock sale, anything related to that is going to be a capital gain. So that's where we have to make sure. Other thing to keep in mind during M&A is what cost to expense and what cost to capitalize. So they call it as a Brightline test. What it really means is anything before the actual transaction has been approved by the board, any expense that the buying company incurs is going to be expensed, and any expense that they incur after it has been approved by the board can be capitalized. So other thing during financing we have to consider during this M&A is the nature of financing, right? So when we are trying to do this, so the deal can be financed either by cash or issuing more debt or issuing the stock. So the best out of this would be maybe if you can issue the stock, the buying entity can issue the stock. The reason being, then there is no gain that kicks in because nobody touched the cash. There is no exchange of cash that happened. So eventually we just got a stock of company A instead of company B, but still got the better deal. So again, financing we have to keep in mind. Other than that, we also have to make sure if the company that we are trying to buy as a buyer, we are not very thinly capitalized. A lot of time, when we are trying to buy a company which is more than what we can chew, we are $1 million company and trying to buy $10 billion company, and we are trying to take on a lot of debt. And when we try to do that, there are some limitations by IRS, how much interest expense that we can deduct. As per today's law, there's about 30% the max that they can deduct. So we have to keep in mind, so don't go very thinly capitalized when we are trying to do these M&A transactions. Another point we have to keep in mind when we are doing this, there's a concept called golden parachute payment. What is golden parachute payment? That is under IRS section 280G, which disallows excess payment made to disqualified individuals. Who are disqualified individuals? These are individuals who are actually in power, who are shareholders or people who can make the executive decisions. So the rule surrounding this is whenever these M&As are happening, they want to make sure the executives of these big multinational companies are not trying to do these transactions just to get a big paycheck out of it. So they have put rules in place wherein anybody, the executives or the shareholders, if they are getting a payment of more than 3 times their base amount. So what is a base amount? Base amount is the average annual compensation over past 5 years. Let's suppose the pay of the somebody in high up in executive position is $100,000 a year, and during this transaction that person got $350,000 as part of the transaction when this M&A happened. In that case, because that money is more than 3 times his or her annual pay, the excess, which is $350,000 minus 300,000, 100,000 multiplied by 3, the $50,000 is subject to one-time excise tax of 20%. So we have to withhold that 20%, which is in addition to all the other regular income tax that person has to pay. So moving along, again, in this M&A, there are certain transactions which are considered to be facilitative and the certain which are called non-facilitative transaction. Facilitative, all the expenses which they assume are needed to incur and make that transaction happen are going to be deductible. Of course, as a buyer, I want to deduct as much cost I can deduct because I want to reduce my profit. But there are some rules that kick in, and one of those rules is if it's a facilitated expenses, irrespective of when it was incurred, it will be deducted. And the line and rundown of those items are preparation and review of merger agreement, negotiating the structure of transaction, obtaining regulatory approvals, appraisal, success-based fees. So maybe we can touch upon what is success-based fees. Success-based fees is an amount which is incurred by a taxpayer with respect to any service provided. Let's take the example of any maybe lawyers, attorneys, CPAs, where they have kind of engaged those professionals, and their fees is dependent on the success of the transaction if it happens. If they are engaged for an M&A transaction and if it goes through, then those people will be paid. Again, this term is called contingency fees, as we may know. In that case, IRS has provided a simplified method and has given a safe harbor rule wherein the expense that is based on the success of a transaction, 70% of that transaction expense we can deduct, 30% needs to be capitalized. And now coming back to non-facilitative expenses. So those are the expenses that needs to be capitalized irrespective of when it was incurred. One is the employee compensation, other is fees paid to the board members for regular meetings, and those are the things we want to keep in mind.